Smart tax planning is not about completely avoiding taxes, but it's definitely about keeping more of what you made. And that starts by fully understanding how things are taxed. Today, I want to give you a quick rundown of how things are taxed in a taxable account. Think your individual or your joint accounts, which essentially is like a savings account, the money that you've paid taxes on, but instead of leaving it in the bank, you decide to invest that money. Knowing how your investments are taxed and then making smart decisions around that is key. If you understand these concepts, it makes a taxable account a lot more efficient than a lot of people realize. We're gonna jump right into it. To sum it up, there's 4 buckets of how the money is taxed in, let's just call it an individual account. Number 1 is interest, and this is any interest you're earning on if you owned a bond, if you have money in a money market fund, if you own other bonds as well, that gets taxed as ordinary income. Next is dividends. There's qualified dividends and there's unqualified dividends. Don't worry, you don't have to sit there and determine if your dividends are qualified or unqualified. They do all that hard work for you. Most US companies and equities that you'll invest in are going to be qualified dividends. There are some exceptions like REITs or preferred stock, but for the most part, the dividends that you get are going to be qualified dividends. They're treated as long-term capital gains. If you don't satisfy the 12-month holding period to make something long-term capital gain, your qualified dividends are still taxed at those lower long-term capital gains rates as opposed to your income rates. You do have a holding period, usually 60 days before the ex-dividend date, but again, qualified dividends are taxed at your long-term capital gains rates. Number 3 is your unrealized gains. You can own something for a decade or 3 decades, and let's say you own Apple or Amazon, or you just bought SpaceX, and it continues to go up and up and up. You're not taxed on those unrealized gains. You're only taxed when you make a sale of those positions. So I wanted to just point that out because I think it's important for people to realize as well. While you're holding something, you're not paying taxes every year just because it appreciated. 4th that we're really gonna focus on is your realized gains. This is when you own, let's say, a stock, and then you sell it. It's at a loss, you're not paying tax obviously on that, but if it's at a gain, you're paying either short-term capital gains, which is if you held that stock for 12 months or less. Short-term capital gains are taxed at your income level, at the brackets. So if you had a $10,000 short-term capital gain, essentially it's just getting added onto your income at the end of the year, and you're paying ordinary income tax rates on it. Good tax rates are the long-term capital gains rates, and that's if you own something for longer than 12 months. The rates there are 0, 15, and 20%. 20% on the long-term capital gains is income above $700,000. Most people are gonna fall into the 15% bracket on long-term capital gains. And again, from the top, qualified dividends get taxed at those long-term capital gains rates of 0%, 15, or 20%. I want to give you a quick example of this. Let's say that you own Apple and you put $90,000 into it. You hold it for over a year for this example. Current value, $120,000. So you have a $30,000 profit that, again, you didn't pay any taxes on it, but once you sell and realize that profit of $30,000 is going to be long-term capital gains. But now this is where I say that taxable accounts could be efficient. Let's say you need $40,000 back for argument's sake, and you want to go make a big purchase. So you want to withdraw $40,000. Of that, $120,000 that's invested in Apple. You're not going to pay capital gains tax on the full $40,000. It gets prorated. So in this example, 75% of your value here is your cost basis, 90 of the 120. 25% is going to be gains. So on the $40,000 that you get back, 40,000, okay, you're going to pay tax on 25% of that. You have 30,000, that's a return of principal. $10,000 is subject to long-term capital gains. So if you're in a 15% bracket, you're only going to be paying $1,500 when you take out your $40,000. So you're not right off the bat getting a huge tax bill just by withdrawing money that you have invested. You're going to have what your basis is, and you're going to have your profit inside of that. Be strategic when you need money back about what you're selling in your account. Maybe you sell a little bit of Apple, maybe you sell a little bit of another stock. The good thing is you could also choose if you want to, which tax lot you want to sell. If you've bought something several times over the years or each month as you're putting more and more money in, and then you decide, well, I want to sell these 100 shares and I don't want to sell those 100 shares because the taxes will be cheaper there, you're able to select which batch that you want to sell. And that's where the tax planning really comes into play. Maybe you just put money in and the market's down and you've held it for a year and you need money back. You're not going to sell something you've held for 7 years that has a gain. Sell what you bought most recently and it might be down or it will be up less, and you could probably have no tax on that. So it's all about being intentional. And your planning it's not something you just do every year when you pay your taxes. It's throughout the year about when you're buying and selling things. It's throughout the year of if you need money back. And knowing, number one, how everything is taxed is important. And then understanding if you're selling a position or if you need some of your money back, what you're going to sell or which lot of shares you're going to sell, as opposed to just pulling out $40,000 of gains. You can pull out, in this situation, it was $30,000 return to your principal and only $10,000 of gains to get your $40,000. So this is how money is treated from a tax standpoint in taxable accounts.